On the Call, a service of Zacks Institutional Services. This is a live conference call featuring Zacks strategists providing their analysis of the latest issues and trends affecting investors, including, but not limited to, the current issues and trends affecting the market, the economy, both globally and here in the U.S. Today, our Chief Equity Strategist John Blank and Tim Nyland, Managing Director of Zacks Institutional Services Division, are going to be putting the U.S. and global markets into perspective for you. And so, without any further ado, John, let's start with you. Basically, you see the global market landscape being what is going to be impacting our U.S. stock market going forward. Is that correct?
That's correct. Yeah, Terry, you'll see I'm going to start out today with the U.S. fundamentals and stock prices, and that they're very, very stable. I don't want to spook anybody in thinking I'm a bear or I'm a bull. I'm neither a bear or bull. I'm in the quantitative assessment, that chart you're looking at right now, that shows year-to-date returns for the S&P are basically zero. And this is the story. Let's look down here at 2014. We had an 11% return. We had 2013 at 30%. We had 2012 at 13.4%. And, if we look forward, 2015 doesn't look all that good at $119 a share, but 2016 at 128 and 2017 at 142. Those are year-on-year growth ranges of 8 and 11%, and that is a 2014 or a 2012 type of arrangement. So somewhere between that future and that past is the current moment. And the question we all have to ask ourselves today, and Tim and I will get into, is how long this stabilization period, stabilization in fundamentals and stabilization in stock prices, how long it goes on. Now, clearly, December is always going to have a Santa Claus rally, and there is small gift buying that's going on out there, and that's probably going to happen. We're probably going to get 3 or 4% out of the next few weeks. But by and large, looking back is over this year, probably is the best estimate of what's going to happen in 2016, which is we're going to have more, at least the first half of the year, more stabilizing effects and more of this going on. Now, if you look down at the bottom of my slide here, you can see what happened in 2015 that was very different than 2013 and 2014. 2013 and 2014 was when the U.S. put quantitative easing out, and it was a U.S.-driven reflation. 2015, all of that reflation, all of that stimulus hit outside the U.S. And so the growth wasn't there outside the U.S., and so the quantitative easing and the Chinese renminbi reset and all the fears and recessions that were outside the United States really got things taken into balance. And the U.S. growth and the U.S. momentum just couldn't overwhelm that stuff, that external stuff. But what happened was stabilization. And this is what's going to go on. And if we get to the next slide, you're going to see that here's where we are on our stabilizing picture. And first forward PE, 12-month forward PE slide with the red line indicating where the mean is. You can see right now my stabilization effort from a PE perspective is basically in its second year. And as you look back from 2002 to 2008, by and large, we had a little run up through 04, and then we had a sinking down for 3 more years. So my call here that we're going to just be in a stabilizing pattern is being borne out by this first picture. Now, what's interesting here is the second picture, which is the Shiller price earnings ratio. Now, we've had a lot of people, get bearish because they say the 10 years of earnings looking back over the current price, which is what the Shiller PE is. 10 years of backward-looking earnings is going to play out. Now, all of a sudden, you can see that the Shiller PE is actually looking a little more attractive now, and the only reason is because we're rolling forward enough in time that some of those really bad periods out there are starting to stop weighing down the Shiller PE. What we're seeing is another paradox that if you look at long enough, if you look at over the big gap that we threw down on ourselves, we're actually in not such a bad place from a stabilization perspective. But by and large, as a valuation market, this market is going to have to run further than it likes to get moving. And that's not a call I'm willing to make. Certainly can happen, but the other call I'm not willing to make is that we're going to get in a bearish rut for the next year or two, and we're not going to see any earnings growth, or we're not going to see any lift in the stock market. I don't actually think that either. But stabilization, very weak returns, very, very stable valuation is what my call is. Next slide, please. Okay, this is the other thing we want to talk about. The stabilizing picture of stocks, again, we have a push-me-pull-you effect underneath that, which is the oil price and the dollar. Now, this chart gives you a really good analysis of how the U.S. dollar rises, gets stronger when oil prices collapse and vice versa. Now, what's the cause here? Is the cause oil prices collapsing, driving the stronger dollar, or is it the dollar collapsing, driving down oil prices, or is it a combination? I think, if we think hardest about what collapsed the oil price, it clearly was the Saudi Arabians who got uncomfortable with U.S. production getting as high as it was. So if that's the cause of falling oil prices, then it's not the U.S. dollar. The U.S. dollar is the effect, and the cause is oil prices, and the Saudis did it. And I think that's probably not all the story. I would think both of these things are entwined, and the kind of reason that happened last year is that we had a second cause, which is European ECB quantitative easing that lowered interest rates and bought a ton of bonds in Europe that pushed the euro down from a 136, which never should have been at, to 106 today. So those two causes, one the ECB into the euro, into the dollar, the Saudis into the oil price, just saying that, and you can see that both of these were caused by simultaneous events outside the United States that then mirrored this picture. So what I would tell you is be a little cautious about the U.S. dollar and the oil price moving in this inverse fashion, because the causes of both of these moves is actually different. The only thing that's similar to both, and we'll get into this about my global picture, is that what the world is struggling with, whether it's oil production, the Saudis, or the Europeans and the United States with Federal Reserve, or China in manufacturing, is that some group that has a big position, U.S. financial markets, the Saudi Arabians in oil and the Chinese in manufacturing, are being challenged by somebody out there who's actually strong enough to push them around. U.S. financial system now facing London and Germany and the ECB and the growing cloud of Europe, and able to push interest rates and finance around. The Saudis facing Russia, Iraq, Iran, North America, they're getting pushed around. And then the Chinese, lo and behold, as strong as we think they are about manufacturing, are getting pushed around in their manufacturing. So this is the struggle right now, is all these things are disparate, but they're all showing us that nobody's strong enough to deal with their globalization issues. Let's go to the next slide. And this is, really a nice story Adam pulled together, Adam Cohen, and I want to thank him for doing this. And what we got here is 4 different prices, all energy related. And the oil price is oil companies, major U.S. oil companies. Solar is a composite that he pulled up on ZRS for solar companies. And the coal is, again, U.S. coal companies, not Chinese coal companies. The final one, the light blue line, is the WTI. So you can see that the WTI, sometime in the 3rd and 4th quarter of last year, left that zero footing and lost 50% of its value. And if we look to the stories of all 3 energy sectors we're looking at, they're all down. Now what's interesting is oil companies in this proxy are down 40%, while oil's down 50%. So coal, of all things, a competitive product, is actually down the most. And if you look at solar, which has nothing to do with transportation and oil, it's down 35% in these slides. So this tells us something that I think is very, very difficult about this market, and that is Oil collapse has shot down the Russian economy, the Canadian economy, iron ore, copper, natural gas, coal, solar, everything. And I don't know if I understand this as an economist at all. What I understand is the short oil trade has been so successful that it has been replicated on any energy stock whatsoever, and some of the less liquid names, more high beta names, have been actually more productive for the shorts than the low beta oil companies. And I think really, when you look at this slide, what you got to realize is that you got to factor in beta, stock market beta, into the energy complex, oil, solar, and coal, and realize when the shorts get oil WT on the run, the high beta names in energy get killed more than even the oil companies. And that should tell us something about the nature of the speculation, that it's really got some leverage, it's got some shorting involved in it, because they're running stuff down from a stock market perspective that's not actually as tightly wound as the oil companies themselves. And I think that's very interesting. Let's go to the next slide. All right, the last thing let's get through here. Again, I talked about Europe a bit, and we all know that there's going to be the trial balloon at 25 basis points in Europe, but I don't think it has any legs in 2016, because I think the European quantitative easing program is boxing in the Fed. I often, when I was an economist privately, I used to always marvel at the fact that if you want to run the central bank in the United States, Volcker, Greenspan, even Bernanke to some degree, you really needed to be in New York, and you needed to have that experience. Because New York was the center of the capital markets, and that's how it worked. So New York, in this respect, is really the central bank, really interest rates, all that stuff's supposed to happen here. And now we've got the ECB, we've got England, we've got London, we've got the pound, the euro, all these things. Germany, they're getting stronger. And while Europe may be getting weaker as from a GDP perspective, it's getting stronger as a financial center. And the U.S. is really facing off with a stronger financial center dealing with GDP weakness. And if you're a strong financial center and you've got GDP weakness, what you're going to do is what they're doing. And the problem with that is we have never, as a central bank, in the 80 years of our central banking system, had to deal with such a cooperative and coordinated continental Europe and a strong England. And as you can see, English unemployment now, the yellow line, is already down in the 5% area. And German unemployment is getting better, and the weak sister is France right now, still at 10%. But ultimately, that's going to keep the euro on the run to parity, and ultimately, that's going to keep the U.S. in a box. So the irony of the situation is Europe, again, is talked about from a weakening perspective, but its institutions through this crisis have actually grown stronger and are now competing with ours. Let's go to the next slide. China. Yes, when we're going to think about all the causes of how the world turns around next year, and you want a bull case, the simplest way to get there is to say that half of the world's GDP growth comes from either the United States or China. I mean, you can see it 8% growth in Thailand, or -5 in Brazil, or what happens in Russia, or even Europe. At the end of the day, if you sum up all the growth in the world, the only two countries that are really generating any aggregate absolute growth, half of that, over half, is China and the United States. So at the end of the day, to simplify matters, there is a way out for the global economy, and it's pretty simple. The United States gets stronger next year, which is not a hard call to make, and China gets stronger next year. And if China cuts interest rates a number of times like they have already, has spending programs up like they already have, the Chinese housing market has already turned, the renminbi has already depreciated and can depreciate more, and the securities regulators have no trouble stopping on shorts and lowering speculation on Chinese securities, which we saw is part of the problem with some of the instability in the energy markets, then it is not hard to make the case that China can, in fact, turn around, and that will turn around the growth story in the world. So when you talk about weak global growth, just remember that there is a big player still, and that's China. Now, what you look down for this ZRS chart, and again, Adam, thank you for this, is the China PMI. And again, you're seeing that 50 number has been in play. I mean, you might see it month to month, but by and large, this economy has been flat from a manufacturing perspective going back to 2011. So 4 years now of very, very stable manufacturing progress in China. So again, here's another part of the world that has always been considered the manufacturing powerhouse. It is still the manufacturing powerhouse. It is not going to not be the manufacturing powerhouse. None of that's going to happen, but it's not going to generate any upside either until it gets new levers of growth, but it may well do that. But at the end of the day, the way forward here is to get China moving, but if you want to look at a chart like this and tell yourself the hockey stick is going to hit in 2016, you're betting on a play that I don't see in this chart yet, and I don't see how we get any motion because it doesn't seem like this thing moves at all. And I think there's some very powerful global forces that are keeping China stable. Not running them down, not getting them bigger, but just keep them stable. And until we see stability change in the United States or China, we should not get bullish on either. And I think that will be it. Let's do the next slide. I think this will be Brazil on my final slide. I want to finish up with Brazil because this is a story from a ZRS data perspective. It looks really quite positive. You know, Brazil was growing, got down to 5% unemployment. Now they're bouncing up to 6.5% here. And you say, well, at least it's not as bad in 2003 when they ran up to 12% unemployment. Well, what you need to understand here is this is the problem, not the solution, because the Rousseff government is a very, very socialist government and has put a lot of people to work in the government and also indexed a lot of private public sector wages to a 10% inflation rate. And so what's going on here is they are warehousing massive amounts of people in the public sector that are overhanging the Brazilian economy, causing fiscal deficits, causing inflation, and running up debt, all of which is leading to an implosion down the road unless it changes. So the thing that's scary about Brazil from a perspective of those of us who are not living in Brazil is if they keep running the debt up and they cause a debt crisis. And this is a big, 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 big country. It's not Argentina. If it debt keeps going, this is the debt bomb that will be scary, and this is what's going on here because they don't have 5% unemployment if you factor in 5 points of warehousing workers at the public sector level, all of whom you're paying and none of whom are being productive. And with that, I think we'll go to the next slide and let my colleague Tim Nyland take over and Terry introduce his perspectives on things that he has pointed out that are going to either confirm or deny my thesis that stabilization effects that are outside the control of big groups that have traditionally controlled massive parts of the global economy are out of control. They're not leading to chaos, but they're leading to stubborn, stable conditions that are just not resolving themselves to the upside. And that's my thesis today, and I'll turn it over.
John, before we bring Tim in, I just wanted to follow up with you. It's certainly a comprehensive landscape that you've laid out here. But on the topic of oil, I wanted to get a little bit more insight from you as far as whether you think there's a possibility that the level of investor pessimism over oil may actually provide some reason for longer-term optimism in that the risk may already be priced in.
That's a great point, Karen. Just before this call, you may have heard me talking to Tim about why you can get bullish on iron ore, copper, and oil right now, and natural gas. And the reason is because now at $38 in WTI, we're below cost for most oil production. And that means nobody, in a variable cost perspective, they'll be producing, but at some point in time when you include the fixed costs of production, you're going to get out of these businesses. Glencore has already shut a lot of their copper businesses down. A lot of these shippers are warehousing ships because there's no point in putting them on the shipping lanes at these prices. So the way that the pessimism gets corrected is not actually from the demand side, Gary, and it's good that you pointed this out and brought this to people's attention. We are getting to a point where the shorting and the pessimism is leaving the suppliers without a profit, and that's how this ends. It ends because nobody can make a buck at these levels, and then prices spring back. And that's typically the cycle we see with commodities and oil, is that once those prices get to the point where people don't produce, they don't produce. And the thing about commodities and oil in general, these are things that are resource driven, and they're in the ground, and there's kind of an inventory out there. And we either draw into the inventory, tap into it with drilling or mining, or we don't. And these processes can be fairly rapid. They can be fairly rapid to shut, and they can be fairly rapid to turn on. So the bottom line is the way out, if you want to get bullish on energy materials, not hard. It's just to say these things have gone too far. No one's making a profit. Supply reductions are coming fast, and they're going to get furious.
Thanks for that, John. Appreciate the follow-up on that. So, Tim, let's bring you in here now for a little bit of a closer look at these underlying U.S. market fundamentals and market areas that may concern you, especially in the event of a Fed rate hike later this month.
Absolutely. Thank you, Terry, and thank you, John. So, yeah, just along the same lines of the U.S. stabilization theme, we're going to take a look at the state of the U.S. consumer, which contributes about 70% of U.S. GDP and consumer spending. We'll take a look at some valuation issues facing U.S. equities and focus in a little bit on the energy patch, as John already alluded to with your question, Terry. That was good. And then we'll take a look at the other 15 to 30% of GDP, which is manufacturing. And again, that's going to be based on how you choose to measure GDP there. But we'll take a look at the manufacturing sector, which is of the utmost concern for me right now. But at any rate, more on the positive side from the stabilization perspective, the slide that we have up on the screen right now, taken right out of ZRS, you can see the recession bands there in the gray. Household income growth, we're looking at finally getting a rebound here, been steadily on the rebound since 2013. And then the civilian unemployment rate, this is the traditional U3 rate, this is the stated unemployment rate. Ticking down around that 5% level. So clearly, from a trend perspective, in support of consumer spending, everything is going in the right direction. And again, this is the bulk of what's contributing to U.S. GDP. So this is a good sign. This is pointing towards stabilization. Next slide. Weekly jobless claims, again, this is going to be initial claims for unemployment. We're literally sitting at the lowest claims since 1999, and you can kind of see that right on the slide there. We're currently sitting below 280,000 claims per week. One thing to note, just from a context perspective, you can see back in 2009, during the height of the recession, we were averaging 650,000 jobs lost per week. So we've come a long way here, and again, we're currently sitting at the lowest initial claims level since 1999. Next slide. This is something that you don't necessarily hear a lot about, but it's something that I really want to point out and emphasize the solid gains that we've experienced since 2011 in the construction spending, and this is going to be both residential and commercial combined. The thing that I find most fascinating about this is that it's actually accelerated substantially in 2015, and we're really not getting a whole lot of press on it. But again, this is really contributing greatly to the stabilization of the U.S. economy. So keep your eyes on this. This is a good one. Next slide. This slide is, again, taken right out of CRS, U.S. auto sales. This is one that you hear about over and over again, and the acceleration, just like we saw in construction spending in 2015, it's solid. Those gains, again, since 2009, you can see the arrows there on the screen. It's just incredible, the rate at which U.S. auto sales are even improving in 2015. So this is, again, this is a good sign, contributing to that stabilization in the U.S. economy. Next slide. So what we're going to do now is we're going to kind of, take our attention and focus a little bit on some of the valuation issues facing U.S. equities. One thing I like to do during these discussions is just at least bring out one valuation metric that I think really needs some explaining, and kind of do a quick deep dive on some startling trends that are apparent out there that you hear get the press, but you don't get really good explanations as to why these valuation metrics appear to be so skewed. When you look at a compositized forward PE on the market weighted average stock in the S&P 500, and you take a look at that relative to its long-term EPS growth forecast. This is going to be your traditional F12M PEG ratio that you hear about. You'll see that this is absolutely frightening. I mean, we're literally sitting at levels that are even much higher than what you would consider the dot-com era. So when people see this, it tends to be a startling trend. And if you go to the next slide, if you lift the hood on it a little bit and actually compositize the denominator, which is going to be that EPS growth rate estimate, that's the long-term growth rate estimate coming in from the sell side, you can see the issue. Prior to the dot-com bust, on average, we had growth rates for the S&P 500 at 15 to 17%. And keep in mind, this is our denominator, right? So as this growth has clearly, between each recession, has set a new level of tranche. We've gone from 15 to 17. Post the 2001 recession, we were at 12.5% on average. Now, since the Great Recession, we're sitting at 10% on average. Then you can see exactly why we've had this rapid inflation in PEG ratio. And when you normalize the PEG ratio out for the growth that really didn't materialize, do we really have a market that's that much more expensive? You can go to the next slide, Adam. You can actually, look no further than your nearest tech stock. So if you were to disaggregate this composite into its members and actually look at these companies that were really skewing valuations for the overall market, it was largely the tech sector. And I've got on my screen here Yahoo. Obviously, Yahoo in the news last week. Interesting to note. Take a little walk back in history for those of you that were in the markets doing this back in the dot-com era. We all remember when Yahoo had 60% long-term growth. Well, now that same growth forecast coming in from the sell side is more like 7.5%. So again, these growth rates, when you actually normalize these for growth that did not materialize, the PEG ratios are actually much higher 1996 to 2000 than they are today. So I encourage you to take a look at this in the ZRS system if you haven't done so. It's startling. Do a little dive into the energy sector, which John touched on very briefly. What we are seeing take place is the buy side getting very conservative in their market implied growth forecast. So what I've done here is I've put the Zacks valuation model up, and I've normalized the earnings through the trough. So you can see that forecast earnings line there take a dip. And what I've done is I've normalized the earnings through the trough. The buy side is actually looking at valuations 24 months out on earnings as far as the recovery. And what we're seeing is a market implied growth rate for the equal weighted average energy stock sitting at about 14%. That level of market implied growth rate itself isn't very significant until the next slide, until you actually look at over the last 20 years what that least squares growth rate has been. And so what you can see for the equal weighted average energy stock is that when you put a least squares fit, and I have normalized the least squares fit along that earnings recovery that's been forecast for the end of 2016, you can see that 20-year least squares growth rate sitting at about 13.4%. So what the buy side has done is they've actually bid the valuations of the equal weighted average energy stock in the S&P 500 down to its sustainable, supportable growth rate, and that is its 20-year least squares growth rate. So we are basically sitting at fair value on average in the energy patch, and it's basically all being driven by the underlying commodity. So an interesting side note there, we do strategy sessions using the Zacks valuation model, so if you're interested in taking a deeper dive in that, contact your account manager and we can schedule a private meeting for that. The next slide, with regard to an interest rate rise in December, I took a look at the ISM manufacturing index relative to the Fed funds target rate, and you can do this all the way back, prior to 1950. The chart gets a little ugly when you do that. I kept it here about 1981. And what you find is that the Fed has really never raised interest rates when the manufacturing sector has been in contraction. We just recently dipped into contraction last week, and so this will be the first time ever the Fed would raise rates with the ISM actually sitting below 50. So it'll be interesting. This is one area of concern that I have, is that, you know, is this contraction in manufacturing enough, you know, to really, you know, put a dent in the U.S. economy? And that's going to be the real question going into next year. How pervasive this contraction really gets. We see that ISM services has actually made a turn as of last week too. So those are two things to definitely keep your eye on going forward. And I think that's all I had, Terry.
All right, Tim, thanks for that. Again, another comprehensive presentation here. Both of you, we're bumping up against the clock, but I did want to ask both of you, in light of everything presented here this morning, should money managers be getting more defensive moving into the new year?
Tim, why don't you go ahead and take a shot at that before I do?
Yeah, I think that I think you've really got to watch your asset allocation. I think that it's rapidly become more of a stock picker's market. You know, clearly, what's going on with the Fed is going to influence a lot about what happens next year. We've got some really strong trends taking place on the yield curve. The Fed is obviously in control of the shorter term part of the curve, and global growth being, you know, responsible for the long end of the curve. You know, yield spreads getting tighter, and the yield curve itself more or less flattening is not necessarily good for financials. So, you know, it's really going to be a stock picker's market. You know, John and I talked a little bit about this not only before the call, but over the last several weeks. It's going to take a major catalyst to kind of get us out of this slow slug that we're going to be in. We're really going to be fighting for, you know, high single-digit returns over the next couple of years, my feeling, kind of at best, unless we have some catalyst for growth. So that's my take, John, if you want to take it from there.
Yeah, basically in that same camp, obviously, Tim and I talked. The bottom line is this stabilization thing is nothing to be worried about, but it is something that you've got to have two strategies in play. One is that single-digit EPS growth goes on way longer than you want it to do it from a returns perspective. So if that's the case, then your plan has to be threefold. One is pick stocks, particularly U.S. stocks. You've got to pick stocks well. Second is you've got to buy small caps at some point. They've been stabilizing for a couple of years, and they're going to get a bounce, and they do have the growth. So I think, you know, you got to take a stab at the Russell. You may not want to take a stab at individual stocks. There's a lot of shorting, a lot of liquidity there. But putting together, you know, a decent, using ZRS, a decent composite of Russell stocks might be the way to go. You know, pick some good companies, pick 10 or 12, build your own composite. That's a really good way to go. The other thing is the international markets are going to turn. The bottom line with the catalyst and the bottom line with the low growth is that the way forward here is that China in particular and the rest of the world gets moving, and the international companies are where the valuations are, and the combination leads that catalyst. There's no question that the catalyst has to be something outside the United States, in my mind. So you have to have the ability first to just pick stocks in the international market right now. I don't think anybody should be playing ETFs in the international market for some time. But then get ready to run with beta in the international markets along with the Russells. So when international stocks and small cap stocks turn, they're going to turn fast, they're going to turn together, and there is going to be a beta play. The answer to when that is going to happen, I wish I were that smart. I'm not that smart. It could be as soon as now. It could be as soon as 3 or 4 years from now. And that's Tim's point, and I agree with, is that from a fundamental perspective, we are in a low returns environment until proven otherwise. But we need to have, and I think you should think about when you manage your portfolios, getting the low returns portfolio together, but then getting a second strategy together to figure out how to transition into a beta right after the valuations are off the table, and that's going to be too late.
All right. Unfortunately, that's all we have time for today. We want to thank our panelists, John Blank and Tim Nyland, and someone who we never hear from, but we always see the results of his work, Adam Cohen, who actually produces this call. If you have any questions regarding our services, feel free to email them to zrs@zacks.com. Likewise, if you would like to be on the mailing alert list, the email alert list to receive John Blank's strategy reports, same email address applies, zrs@zacks.com, or contact your ZRS representative. In the meantime, thanks for joining us. Have a great holiday season, and we look forward to the next time we're all on the call.